Ladies and gentlemen, welcome back to the channel. AMC Stock closed down about 3% today. The whole financial system could be on the brink of collapse. Now, what we're going to talk about here in this video, I hope does not come true. Let's be honest here. I hope I am wrong. I hope this means nothing. I hope we don't have to look back at this video and say, dang, we called it. I hope so. I truly hope we're not facing the problems that I think we could be facing. But with that being said, we're not going to ignore the possibility that this is correct. Now, on top of that, we're going to get into what's going on with AMC stock, how AMC could be affected if the worst case scenario is realized here with this calamity, with this crisis that I think is coming, or at least possibly is coming. I think you're already kind of in crisis mode. Just does this turn into a full-on financial collapse or not is a bigger question. Now, what you'll see right off the bat with AMC stock, let's go ahead and start this video off light. You'll see that AMC's cost to borrow max is now at 272%. Huh? Those are some numbers we haven't seen in quite some time. If you take a look at the shares that are currently sold short, that is up 3.55 million here on the day. 25.27 million shares are currently sold short, with the live short interest of free float of 12.78%. This is up 16.32% here on the day alone. So there is a lot of shares that were sold short here over the past couple of days. At least that's what it looks like to me. Now, at the same time as this, the put to call ratio continuing to decline at 0.79. So for the first time in a long time, almost a year now, you now have more calls than puts on the option chain. If we blow this up, look at the bubble chart for this week, you're seeing a lot of activity around the 850 call as well as the $8 call. The $8 call is seeing volume today of 6,000 with open interest of 12,000. The let's see, the call here at the 850 is seeing open interest of 17,000 with volume of 7,000. So if we can get an upside move, maybe it could be quite explosive. If you take a look at the put activity, the 750 put has 4,000 for open interest. The $8 put has about 6,500 for volume to date and about 13,000 for open interest. Now, earlier in the day today was a much, it was much better, right? You kind of collapsed throughout the day today, and I think a lot of this has to do with this crisis that is currently going on. So we're gonna go ahead and get into that as well. There's not really any news here on the day with AMC stock. Everything was kind of doing poorly. Most stocks in general had a really rough day. S&P was down 1.33%. If you look at the S&P on a technical basis, you are below your kind of line here that has marked the bottom last October, connecting the bottoms of the most recent pullbacks in this same year or so time frame, and you're now below that line here. So that's not looking good for equity markets, and really what's going on here is not great. So TLT down 2.15% today. The bonds are getting smacked in the face right now. The KRE was down about 2% today. Oil was up 0.67% today, and the dollar was up 0.74% today, hitting a new high of this cycle. The NASDAQ as well. The NASDAQ looks a little bit better, or the NASDAQ 100 at least looks a little bit better than the SPY, just connecting the most recent downturn you've seen back here in August with the downturn you've seen briefly back here in June, connecting these three lows. And the one you just hit back here, September 27th, you're still above that. So the NASDAQ looks a little bit better, but the NASDAQ was down 1.76% here today. So the NASDAQ starting to outpace to the downside. If the NASDAQ breaks under this line right here, which I think almost certainly will happen, then you make your way down to the 200-day moving average around 330. If you look at the SPY, the SPY is pretty close to its 200-day moving average, whereas the NASDAQ is not near that at all. So that could be maybe a leading indicator that we get a little bit more downside to the NASDAQ from here than we do get for the SPY. So keep that in mind. The NASDAQ here is what you'd need to see a move down of about 7% to get to that 200-day moving average, whereas the SPY, you would only need to see a move down. Let's go ahead and pull this up of roughly 1.27%. So the NASDAQ is holding up a lot better. We'll see if that does ultimately flip. I do think that's probably likely. So, you know, it's just one of those things you want to be watching for. If I were to have some downside exposure, downside protection, in which I do, it's on the NASDAQ here. It's not on the S&P. I want to catch that catch-up drop, if you will, of the NASDAQ if that does happen to hedge out my portfolio. Now, let's take a brief overview of the Ortex data here with AMC Stock. Then we'll get into this potential crisis that is brewing. And again, I hope it's not. I hope I'm wrong. But this was kind of self-induced by the authorities. We'll just call it that. So AMC Stock has a short score of 64. Dollar amount currently sold short of 177.04 million. Estimated short interest of free float at 10.98%. Free float out on loan at 13.26%. Shares out on loan 26.23 million. Days to cover 1.75. Cost to borrow 2.74. And utilization of 54.25. So that's kind of your data here. There's not really too much else to actually say. Again, just a look at the Stonko tracker data. This week, you have like 2-to-1, 3-to-1 almost calls compared to puts, especially calls in the money of 22,000, puts out the money, or puts in the money of 7,000. So literally a 3-to-1 ratio here for calls to puts. So that makes me a little bit more bullish here on AMC stock. AMC did hold up a lot better than some of the other stocks I own. So AMC is definitely the outperformer today, even though AMC stock dropped about 3%. So, okay, now that the light stuff is out the way, hopefully you guys are a little conditioned for this. So, let me pull this up for you first. I think we can start here. This is the unrealized gains and unrealized losses on securities at commercial banks. This is in the billions. So this is from wolfstreet.com. Source is the FDIC. So what you're going to see here is even back in like '08, the losses were like less than $100 billion. Now look at the losses. They're massive. Okay. They reached as high as almost 700 billion in the most recent month. You were down here at about 500 plus billion, about $550 billion of losses. So what is causing these losses? I think a lot of people don't understand this fully. What's causing these losses here? Well, number one, the bond market. Look at TLT. This is on a weekly chart, just so you can see how dramatic this fall has been. From the COVID high of 167 to where we are now, about 84. This is an ETF that tracks the 20-year treasury. Well, you can see you've dropped about 49.5%. Today was another just brutal day for the bonds. You are way off your 50, 100, 200-day moving averages. You are at the lowest level that you have been, since back here in '08. But when you look at the relative kind of action here, right, you've never seen a collapse in bonds like this. You've seen down periods in bonds, sure, but you have never seen a collapse, a pure collapse in bonds. This is because of what's happening right now. So let me put it to you like this, okay? Banks, right? They are very regulated on what they can put their customer deposits money into. So what happened during COVID, Rona? The government gave out trillions of dollars to individuals. Okay. So what did those where did those trillions of dollars go? They went to the banks. Well, the banks were forced to do something with that money. They can't just let that kind of money sit on their balance sheets. There's risk there. Now, they're not regulated or not allowed, I should say, to go out and buy just any old stock out there, put all their money into YOLO options. They're not allowed to do that. They're a bank. So they're basically forced, or were forced, to go buy bonds. Long duration bonds, for the most part. And then what happened? The Fed started raising rates. The Treasury, or the government, started spending a bunch of money. So they had to raise a lot of bonds. That means selling bonds onto the market. So you have the Fed raising rates. That's putting upside pressure on bond yields. Downside pressure on this chart. You have the government and the Treasury spending money like they're drunk, which when they issue bonds, they're selling bonds onto the market, directly pushing TLT down and bond yields higher. And what's happening in the meantime? Well, the Fed's raising rates, so people are demanding more for their deposits that they're holding at banks. So while banks locked in their rates in the bond market 1% to 2.5%, they're now forced to pay out 5% in most cases, 4 to 5%. So they're getting squeezed on not only just their bonds losing value, as you can see from this chart, they've lost about 50% of their value in the last couple of years, but they're also getting squeezed on the bonds they do own that are down 50%, are paying them out 1.5 to 2.5%, and they now have to pay out 5% for consumer deposits. Both of these are bad. But what does the bank do? The bank puts their money in these bonds, and then they use them as collateral. So it's really the collateral that could be a problem here. Because if the bonds continue to lose more and more value, then that collateral could be at stake here. Now, you might be wondering, what's used to kind of hold that collateral, right? Well, obviously bonds, but a lot of these are securities loans. A lot of these are loans against stocks or collateral against stocks because, hey, if you are a bank, right, and somebody's like, can I have $1 billion? I'll give you these bonds. They're worth $1 billion. I need $1 billion worth of leverage on top of that. The bank goes, fine, I got $1 billion worth of bonds. That's cool. They expire or mature in 5 or 10 years. That's cool. But these bonds are paying out 1%. That bank goes ahead and lends out $1 billion, just for an example here. Invests that hedge fund or market maker or whatever, institutional investor, goes out and spends that $1 billion on stocks, which probably have not performed all too well to make matters worse. Now the bank is just lent out $1 billion. They're sitting on more bonds that are worth even less. So the collateral value is no longer 1-to-1. It's no longer 2-to-1. It could be 5-to-1 because the bonds have lost so much money. Usually the banks will give you a ratio, right, on the collateral in bonds. Kind of like margin debt. You're allowed to go into a 100% margin debt. Probably the same way when it has to do with bonds and kind of exposure, right? Your margin levels, if you will. So that's also a big problem, and it's really hard to say where all of this kind of collateral is at. A lot of it is probably in securities, though. Take a look at this article. This article is was written, where's the date on this? October 11th, 2021. It says, banks are binging on bonds, but not because they want to. Banks are awash in deposits, and their customers are taking out fewer loans, so they have little choice but to buy up government debt, even if it means skimpy profits. That's not good. Rates on Treasury bonds are still near historically low levels, but banks have been buying government debt like never before. In the second quarter of 2021, banks bought a record of about $150 billion worth of treasuries, according to a note published this month by JP Morgan analyst. Quote, Widget companies make widgets and banks make loans, said Jason Goldsberg, a bank analyst at Barclays in New York. This is what they do. It is what they want to do. By putting their customers' deposits into investments such as loans or securities like treasury bonds, banks make the money needed to pay interest on those deposits and pocket a profit. When the economy is growing like now, banks usually have no problem finding borrowers as customers make big purchases and businesses expand. These loans provide better returns than treasury bonds, which are usually reserved for times of uncertainty. Because banks will accept their lower rate of return in place of a risky loan. Quote, there's been this economic expansion coming out of what was a significant contraction, said Bain Rumor, an analyst covering North American banks at credit rating firm Fitch. And typically what would happen would be, yes, increased demand on corporate side and the consumer side, and that has just not manifested itself yet. So basically the problem was that they were complaining about here is people not taking on enough debt, right? Not taking on enough loans. But you could see the banks were just forced to buy all of these bonds. This says right here, M&T Bank, a Buffalo-based lender with a focus on the Northeast and Mid-Atlantic states, had fewer loans on its books at the end of the quarter as the bank struggled to find profitable places to put money. Quote, customer deposits are at an all-time high and growing faster than our ability to deploy them into assets. And so the banks have turned to government bonds, where interest rates have been low for more than a decade. When the yield on the 10-year Treasury note briefly rose to around 1.75% in March and April, banks hungry for higher returns rushed to buy them. A scramble that helps explain why the spike in interest rates didn't last, analysts say. I hope you guys are picking up on what we're putting down here in this video. The banks rush to these bonds. Now, we've seen what has happened in the beginning of this year. Some of the smaller guys, the guys that are more vulnerable to, a credit crunch, collateral crisis, they've already went down. It could be the mid-tier banks that are now in trouble. Because, again, the bonds, the value decrease of the bonds, that's one thing. But what's going on with the collateral, right? The other side of that. That's what we don't have clarity on. Did it go into real estate? Did it go into stocks? Did it go into more bonds? Remember CDOs, collateralized debt obligations? If you guys have ever watched The Big Short, then you know about this. Basically, there was bets on top of bets on top of bets on top of bets. What if just that money that was collateralized with a bank was put into betting on more bonds? You don't know how deep this spiral goes. But I'll tell you right now, if you take a look at KRE, the situation's not getting better. I would argue it's probably getting even worse, right? And it wouldn't surprise me if you start to see more banks starting to go under, or at the very least, having some big problems. We are going to be starting earnings season here pretty soon. I believe next week is the official start of earnings season. And you're going to start to get some banks that report earnings. Those bank earnings are probably going to be pretty brutal. And that could be a problem for our markets. This could send up yields even more. This could cause the Fed pivot. They might need to pivot if these bond yields continue to rise at the pace in which they are. So that's what I have for you guys here in this video. Let me know what you think about this down below in the comment section. Where do you think this collateral has went, right? I think that's a fascinating question to ask. I can't find too much data on this. So I would love to hear your opinions on this. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with us live in real time, link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.